whether or not this applies to you, is that you only need to use this information if you have employees that aren't 100% full-time or 100% part-time. So this is going to apply to people where they work seasonally, or they'll work a lot of hours on a project and then maybe won't work at other times. You see this a lot in home health care, construction, like janitorial services have that. So if you have a workforce where everybody can be for sure called full-time or for sure called part-time, and they don't swing back and forth, then this is not going to be an exercise that you will have to attend. Okay? So I'm going to turn it over to Caitlin and ask you to let's go for it.
All right. Thank you very much, Kelly. Again, thanks to Kelly and thanks to More Benefits for hosting the seminar today. Just a little brief introduction to myself. If you didn't attend our first webinar 2 weeks ago, my name is Caitlin. I'm an attorney in Minneapolis, Minnesota at the firm Seton Peters and Revenue. We practice exclusively representing employers in sort of all aspects of everything that comes up. When you are an employer and when you have employees, I specifically dedicate my practice to the benefit side of things. And so I work on a day-to-day basis with employers setting up their benefit plans, helping them understand and apply new rules with the Affordable Care Act, answer questions basically on everything that relates to benefits, whether it comes through FMLA, through benefit plans, through workers' compensation, unemployment, things like that. And so that's what I generally do on a day-to-day basis. And a lot of those questions recently have been centered around the Affordable Care Act, and specifically for those employers that fall into that large employer category. And so More Benefits sort of developed these 3 webinars to give you more information, sort of a reminder on some of the important things, help you apply some of the more new rules and regulations. And this is our second webinar. Our first webinar, we talked about how to determine your size and the type of coverage you have to offer if you do fall into that large employer category. And then I do want to point out we are going to have one more final webinar, the third in the series, on Wednesday, June 24th. And so that's 2 weeks from now, same time, same place kind of thing. And we will be talking about the brand new Affordable Care Act IRS reporting requirements. These requirements are brand new. No one has filed these forms before, and they apply to all employers with 50 or more full-time plus full-time equivalents. And so I assume everyone on here falls into that category, and I would highly encourage you to attend this next webinar. All the information is new. We will take a look at the actual forms that you will use, get an idea of the information you need to be collecting, because there is a lot of information and you should be collecting it already.
I'd like to jump in on that and let everyone know who is a client of More Benefits that we do have 2 different ways to help you, 2 different tools to help you prepare those forms. One is an online portal. It's our Employee Navigator system. We've built out the ACA piece for you to import your hours, import your employees, and then we're already tracking your benefits. So we'll be able to present the information in a way that will make the filing much easier. And secondly, we also have a spreadsheet method. So we'll be supporting you on that. So as you look at this, just know that we are also studying these rules and are investing in tools and technology to help you to do your reports. Okay?
Awesome. And with that, again, that's Wednesday, June 24th for the last webinar. And let's go ahead and get started with today. There's a lot of information to cover. I'm going to do my best. We're going to end, on the hour, whether or not we get through all the slides. But just so you know, you will get a copy of the presentation. You can contact Kelly after the presentation's over. She'll have a copy of the PowerPoint slides, and you can always send follow-up information or questions to either Kelly or myself, and we can help you with that. Just a little brief introduction. Again, we are talking about the employer mandate portion of the Affordable Care Act, where applicable large employers, also called ALEs, those are generally those with 50 or more full-time employees with full-time employee equivalents, have to offer affordable minimum essential coverage that offers minimum value to their full-time employees and their dependents, And you get penalized if you don't offer coverage. You also get penalized if you do not offer affordable, minimum essential coverage, minimum value coverage. Obviously we covered this in the last webinar that in 2015, employers with 50 to 99 full-time plus full-time equivalents do not get penalized. And so there may be some of you on this webinar that are sort of in that category, that size, that might be looking at using the look-back measurement method for next year, or there might be some of you that need to apply this method now and are in the 100 or more. But just, again, to reiterate, 50 to 99 don't get penalized the first year, so keep that in mind. We are talking about the look-back measurement method, which is a way for employers to sort of determine who's full-time, who's averaging full-time hours, to determine who they need to offer coverage to. Like Kelly mentioned at the beginning, this is a method that is helpful for employers that have a lot of shift workers, think restaurant, hospitality, things like that, where employees maybe pick up shifts and work 80 hours one week and 10 hours the next week. And you're like, well, great. Are they full-time or not? Because, some weeks they are, some weeks they're not. 1 month they are. We have a busy summer season, and everyone's full-time. And so this method was developed to help those employers sort of average out the hours their employees work over the year and help them determine who they need to offer coverage to avoid a penalty. The basic idea of the look-back measurement method is that if an employee averages 30 hours of service a week or 130 hours of service a month during their measurement period, the employee is considered a full-time employee during the stability period, regardless of the actual hours that the employee works in the stability period. So the thought is you look back, average out their hours, and then apply that for the stability period. Then you have a period where the employee's full-time or part-time status is not going to change, and it makes administering the benefits a little bit easier. A few things to keep in mind during this whole presentation. This method is optional. I cannot stress that enough. Do not use this if you don't have to. Kelly gave some great examples of people that might benefit from using this method. And yes, it can be very helpful for those employers that don't know who's full-time on their staff, or their staff just fluctuates so much that there's no way for them to know ahead of time who's going to be full-time. If you know who's full-time, you know all of your employees are full-time, do not even bother with the look-back measurement method. It is too much administrative work. There are too many rules. Don't use it. It's optional. Also keep in mind that this method it's used for determining which employees to offer coverage to. It's going to also help you determine which employees need a Form 1095-C. That's that new IRS reporting form that we briefly talked about at the beginning. That's what we're going to be talking about during the next webinar. But the look-back measurement method helps you determine who to offer coverage to, who you are going to consider a full-time employee. You do not use this method to determine if you're a large employer. This has no bearing whatsoever on determining your size. Also, this has no bearing on what penalties, if any, you are going to be assessed. The penalty calculations are based on your true full-time numbers, not an average over the year using the look-back measurement method. Same thing if you are determining if you're a large employer, you use the true hours your employees really work to determine full-time or not. You do not use the look-back measurement method to determine your size. You do not use the look-back measurement method to determine what penalties you might be assessed. So let's go ahead right off the bat and get some terminology out of the way. The terminology is very important when talking about the look-back measurement method. It is, a lot of new terms. They all have their specific definitions, but it's nice to know, especially if you have questions, to know the terminology. So there are three big periods we're talking about when we talk about the look-back measurement method. The first period is called the measurement period. And this is when you collect the hours from the employees. These are the hours that you use to average out to determine an employee's full-time status. There are two types of measurement period. There's the standard measurement period, which applies to your ongoing employees, and there's the initial measurement period, which applies to your new employees. And we will dive into those 2 periods and the rules for that and what's an ongoing employee and who's a new employee in a little bit. But just for terminology purposes, the measurement period is the actual period where you look back and you look at the hours everyone worked. Keep in mind that measurement periods are going to run back to back, and you'll see that in a few examples later on. The next period to know is the stability period. The stability period follows the measurement period, and the stability period is when the employee's full-time or part-time status is locked in. And so if you determine the employee is going to be full-time for the stability period, they are full-time for the whole stability period. Another good way to think about the stability period is that's when you actually offer your employees coverage. So the stability period is basically the coverage period for your employees. The stability period also runs back to back because you don't want breaks in coverage. And so your employees are always going to be in a stability period. We'll see how that plays out in a little bit. And then lastly is the administrative period. The administrative period is this time frame between the measurement and stability period when you do all the administrative work. Things like actually doing the math to average out the hours everyone worked, providing enrollment materials, having open enrollment. You do not have to have an administrative period. It is optional. I would always recommend to have one. Otherwise, your measurement period ends on a Friday, and come Saturday, all your employees have to be offered coverage. It's sort of administratively not feasible to not have an administrative period, and so I'd always recommend having one. A few other things to note before we jump really into the material. When we talk about averaging full-time, we talk about 30 hours a week or 130 hours a month. The IRS determines that 30 hours a week averages out to about 130 hours a month, and so that's where that 130 hours a month comes in. And with that, let's go ahead and talk about a few other things. So in our first webinar, we talked about controlled group rules, controlled group members, and determining your size, and how being part of a controlled group, a parent subsidiary or a brother sister group of corporations can impact your size. Just keep in mind that once you've determined that you're part of a controlled group, the controlled group's a large employer, you can separate everyone back out again, and each member of the controlled group can have a different measurement period, administrative period, stability period. One controlled group member can do the look-back measurement method, and not everyone has to, things like that. Also, within your organization, you can have different classes of employees with different periods. So there are 4 different classes of employees that you can have a different measurement, administrative, and stability period. That's collectively bargained versus non-collectively bargained, different collectively bargained agreements, salaried employees versus hourly employees. I know that one actually does impact a lot more employers. And so if you want your salaried employees to have one type of measurement period and your hourly employees to have a different type of measurement period, you can do that. Also, if your employees primarily work in different states, you can have different measurement, administrative, and stability periods. So let's go ahead and talk about how you categorize your employees. There are different rules for how to apply the look-back measurement method depending on the type of employee you are looking at. And so the type or the category of employee will determine what measurement, administrative, and stability period you use. So the first type of employee is an ongoing employee. An ongoing employee is someone who has been employed for at least one complete standard measurement period. For example, if you have a standard measurement period of 12 months, then your ongoing employees are those employees that have been employed for 12 months. Fairly straightforward. The next category of employee is a new full-time employee. This is a new employee who has not been employed for a full standard measurement period, someone you recently hired or just hired, and you reasonably expect them to work an average 30 hours of service per week. And so when you take a look at that, consider how you advertise for the job, consider what you tell the employee, But generally, you should have a decent idea if a new employee is going to be working full-time hours or not. Your last category of employees is sort of like the catch-all. These employees that are new, variable hour, and seasonal employees. These are the employees that might be full-time, but they're new, but you don't know. You can't determine if they're going to average 30 hours a week or not. You hired them, maybe you're a restaurant, you hired a ton of new employees in the summer, and some of them will probably work full-time, some of them won't, some of them might fluctuate month to month. And so you just don't know. And you don't know because you've considered whether the employee is replacing a full-time employee or not. You've looked at the other employees you have in comparable jobs, and you take a look at how you advertise the job. Was it advertised as full-time? Was it advertised as part-time? Did you promise the employee to work that they were going to work 30 hours a week? So take all of these factors into consideration when determining if this new employee is variable hour or full-time. No one single factor is determinative, and you can consider other things as well. But there are some ideas of helpful things to look at when you're trying to figure out, is this new employee going to be full-time or not? Make sure you don't consider if the employment is going to end at a certain date. Again, going back to the restaurant example, you hire a bunch of college kids over the summer for your busy season. You sort of suspect most of them will be done with their employment at the end of the summer, but you don't know, and you cannot take that into consideration when determining if the employee is new full-time or a new variable hour. And so if you hire a bunch of college kids for the summer thinking, yeah, I promised them 30 hours a week, they're all going to be working full-time, you have to treat them as a new full-time employee regardless of the fact that you think they're all going to end their employment at the end of the summer. The last part of this new variable hour sort of bucket category of employee are seasonal employees. Again, fairly similar to our example with the summer college kids being hired on at the restaurant. A seasonal employee is an employee hired into a position that's generally less than 6 months. And so the position occurs at the same time every year. It's less than 6 months. It's really a seasonal position. Think holiday season with with holiday season at like Target or Walmart or something like that. They hire on a ton of employees for the holiday season. Their employment lasts less than 6 months. It occurs at the same time each calendar year, every winter. Another example, a ski instructor at a resort. There could be things that impact the length of the employment, like, oh, there's a really heavy snow this season at the resort. This instructor stayed longer than 6 months. But in general, the employee in the position generally meets the requirements for a seasonal employee. You can treat them as a seasonal employee. So if you have a seasonal employee, you cannot ignore them. If you have a seasonal employee, you have to treat them like your other new variable hour employees, and you have to measure them in a measurement period. Even though you know their employment's going to end, we just mentioned on the last slide, you cannot take that factor into consideration. You have to still measure them using the look-back measurement method. You treat them just like other new variable hour employees. You measure them with an initial measurement period. You cannot ignore them. One other thing to keep in mind with your seasonal employees, this seasonal employee definition is specific to the look-back measurement method. It does not apply in any other context. For example, there's a seasonal worker exception when you determine the size of your workforce. So in determining employer size, there is a seasonal worker exception. The seasonal employee definition does not apply in the seasonal worker exception. And so you sort of got to, take a look at what terms you're using and if you are determining your size or if you're applying the look-back measurement method. The seasonal employee, which is at 6 months or less, same time each year, is strictly for the look-back measurement method. So now that we know our 3 different classes of employees, let's talk about what we do with each one. So each process employee is going to have its own rules for measuring the employees, putting them in a stability period, and offering them coverage. The first type, the ongoing employee, is the most standard look-back measurement method rules. And so ongoing employees have a measurement period, which is called the standard measurement period, of at least 3 but not more than 12 consecutive calendar months. The stability period depends, the length of the stability period depends on whether the employee is full-time or part-time. If your employee is full-time, their stability period has to be at least 6 consecutive months or the length of the standard measurement period. If the employee is part-time, it can't be longer than the standard measurement period. The administrative period is up to 90 days long. Keep in mind, 90 days is not the same as 3 calendar months. Could be the same as 3 calendar months, is not always the same as 3 calendar months. One other big thing to keep in mind is that the employer can pick when the measurement period starts and how long the measurement period is. But, big but, to avoid penalties, you have to be very strategic about when your measurement period starts and ends, because that's going to determine when your stability period starts and ends. For example, let's talk about a large employer, over 100 full-time employees, with a calendar year plan year. So their plan year starts January 1 every year. Let's say that this employer was a little bit late to the ball game here in setting up their measurement period, administrative period, and stability period in preparation for the beginning of 2015. So they ended up with a measurement period of April 2014 through March 2015. They set up their administrative period to be April and May 2015, and they set up their stability period to begin June 1, 2015, and that is when they started offering coverage. June 1, 2015. But their plan started January 1, 2015, and they were susceptible to penalties as of January 1, 2015. They could have missed some full-time employees, did not offer them coverage until their stability period started on June 1, and therefore might be paying penalties for January through the end of May of 2015 because they set up their stability period incorrectly. So let's see how this plays out. You can take a look at this lovely little chart I made and see how, first of all, a few things I want to point out, how all of the periods overlap. M stands for measurement period, A stands for administrative period, S stands for stability period. But you can see that you are in multiple periods at the same time because you want to start, you always want to be in a stability period. Your employees always need to have coverage being offered. Therefore, you always need to be in a stability period. So you have continuous measurement periods. The next measurement period starts immediately after the previous one ended. Same things with your stability period. Your stability period, your next one starts immediately after the previous one ended. In this example here, it is the example, or one way to set it up. One of the recommendations I generally make in setting up your measurement period, your standard measurement period and stability period for a calendar plan year. So you want your stability period to match up with your plan year. So you get a stability period of January through December. You have a 1-month administrative period in December. And then you have your measurement period, which is December through the end of November. So you can see the red is measurement period 1. Started in 2013. This employer, or an employer utilizing this, would have really had to plan ahead. So they started their measurement period December 2013, ran it through 2014, had an administrative period, the purple, in December of 2014, then started their stability period January 1, 2015. And so you can see how that stacks up year to year to year in all of the overlapping and how you're always in a stability period, always in a measurement period. Now, I recommend always using 12 months for your stability period and for your measurement period. And this is why. So I have attempted to map out what happens if you use a shorter measurement period. And this happens when you use, for example, a 3-month measurement period, because the rules say that if you have a full-time employee, their stability period has to be at least 6 months long. So you have a 3-month-long measurement period, but a 6-month-long stability period. But your part-time employees can't have a stability period that's longer than the measurement period. So your part-time employees end up with a stability period that's 3 months. So you can see in the little chart, everyone's got the same measurement period. Great. Measurement period 1, 3 months long. Everyone's got the same administrative period. The first administrative period, A1, purple, in April. Everyone's great. Wonderful. All right. But now things sort of go askew because your full-time employees have that 6-month stability period. That is the FT-S1, full-time/stability period 1. But down sort of underneath, the part-time -S1, PT-S1, is the 3-month stability period for your part-timers. Now, because your stability periods have to run back-to-back, now your measurement periods no longer match up. Measurement period 2, part-time measurement period 2 are not the same. You're going to have 2 administrative periods, one for your full-timers, one for your part-timers. And then you're going to have different stability periods. You've got a full-time stability period and a part-time stability period too. And so things just get significantly more complicated administratively. That being said, it is allowed. You can do this. This is fine with the rules. Fine with the rules. But remember, in addition to keeping track of all this, you're going to have to allow employees on and off the plan every time there's a stability period. So in this example, you have to allow employees on and off the plan in May. You have to allow part-time employees on and off the plan in July. You have to allow your full-time employees on and off the plan in October. And it's just going to continue like that throughout the year. So not only do you have the administrative hassle of tracking who's full-time, who's part-time, who's in a measurement period, how long is their measurement period, which stability period do they go to, how long is their stability period, is it the 3-month one, is it the 6-month one? You also have to connect with your plan and make sure your insurance coverage can be offered this many times throughout the year. And then, on top of all of that, you have to watch for issues with any type of cafeteria plans or pre-tax arrangements that do not allow you to change things mid-plan year. You have to lock that in for an entire plan year. So you might have employees going on and off your major medical coverage, but stuck with their pre-tax arrangements, but going from full-time to part-time during the year because of the way you set up your stability period. All of that, big, long explanation of why I highly recommend 12 months for both your measurement period and your stability period. My practical tips are determine your stability period first and work backwards. So match up your stability period with your plan year. Whatever plan year you have, great, wonderful. It's 12 months long. Oh, guess what? Your stability period is going to be 12 months long. You just match it up. Then you've got your stability period matching up with your plan year. You don't need to worry about getting people on and off mid-plan year. Works out very nicely. Insurance carriers are much happier working with something like that. And so I would highly recommend that. Then you work backwards. So you've got your stability period. Then, again, like I mentioned before, have an administrative period. I highly recommend you have an administrative period. Say you want 2 months to figure out all the administrative work. Great. So you take the start of your stability period, work backwards 2 months, there's your administrative period. Now you work backwards again and do 12 months for your measurement period, count back 12 more months, and you're set. You have set your measurement, administrative, and stability periods for your ongoing employees. Moving on. Now let's talk about our new full-time employees. Remember, these are the employees that we determined that we're going to average 30 hours a week at the start date. We're just like, yep, we hired them on as full-time. We know they're going to be working full-time. What do we do with them? You have to offer coverage to them within 3 months. So you have to offer coverage before the end of the 3rd month of employment. The issue that comes up here is is matching that 3 months up with the 90-day waiting period. And so as most of you are hopefully aware, there's the 90-day waiting period limitation. You can't have a waiting period longer than 90 days. 90 days is not the same as 3 months. In addition, new waiting period rules, if they're not so new anymore, they came out in 2014, stated that you can have a bona fide orientation period and then start your waiting period. And so in theory, an employer can have up to a 1-month bona fide orientation period, and then after that 1 month is over, start the 90-day waiting period. And if this is all set up correctly, that doesn't violate the waiting period limitation rule, but now you've waited longer than 3 months to offer this new full-time employee coverage, and you could trigger a penalty under the employer mandate. And so watch for that interaction with new full-time employees and the waiting period limitation. So just keep an eye on that. Also, you're going to start measuring this new full-time employee during the next standard measurement period. So basically, this new full-time employee is offered coverage within the first 3 months. Then they get dumped into the bucket with the rest of the ongoing employees, and they transition into a regular ongoing employee with the ongoing employee standard measurement period, administrative period, stability period, and you don't have to worry about them anymore. You've dumped them into that ongoing employee bucket. And we'll see how that works coming up here on the next slide. One other thing I wanted to mention, so during that first 3 months of employment, while basically the employee's in their waiting period, they are not going to trigger a penalty for the employer. As long as the employee is otherwise eligible for coverage, basically the employee gets hired and it's like, yep, you're eligible for benefits, but you got to satisfy the waiting period. You're not going to be penalized for technically not offering coverage during those first 3 months, just because on some level the IRS, Department of Labor, understands that there are these waiting periods out there, and that's fine as long as your waiting period complies with all the rules, and as long as you offer the employee coverage within the first 3 months, there will be no penalty. So let's take a look at how this works. So you can see sort of the same setup for measurement period, administrative period, stability period, measurement period 2, administrative period 2, stability period 2, etc. So those are all the periods for the normal ongoing employees that we just finished talking about. Same exact slides, same exact things. But now you have an employee who's starting August 1. They are a new full-time employee. You know that they're going to be full-time, but they're starting towards the end of that measurement period. What do you do with them? You got to offer them coverage within the first 3 months. So you say, great, wonderful, with our waiting period, they're going to get coverage October 1st. So, yep, wonderful, it's within the first 3 months of employment, everyone's happy, everyone's great. So this employee gets offered coverage October 1. And then you start measuring them during the next measurement period. So measurement period 2 begins in December, and you start measuring them. So you've offered them coverage in October, and they just get to, if they accept the coverage, they're like, great, yep, I've got coverage, yay, I have coverage. And they keep their coverage all the way through that measurement period. So that December all the way through November, we're looking at measurement period 2. You have the administrative period, A2. And then you decide, now they're basically an ongoing employee. And so you take a look at the hours that they averaged, and you continue offering coverage if they're still averaging the full-time hours. Or at that point, during the stability period, which on this chart is stability period 2, that light blue S2 down at the bottom, at that time, if this new employee did not average full-time hours, so maybe you hired them to be in a full-time position, you really thought they were going to be working full-time, but after the first 3 months of employment, things really slowed down. And this employee ended up not averaging full-time hours during that measurement period. You can then stop offering them coverage during the stability period. So that's how you transition them into an ongoing employee. Now they're just treated like every other ongoing employee. You keep measuring them. You keep either offering coverage or stopping coverage, depending on the average hours that they work, et cetera, et cetera. So the big question that pops up a lot when talking about new full-time employees is, why would I classify someone as a new full-time employee compared to hiring someone and being like, oh, I have no idea how much you're going to work. You're a new variable hour employee. So if you can classify someone as full-time, I would recommend doing it because it is administratively significantly easier to just offer them coverage within 3 months and then dump them in the ongoing employee bucket and treat them like every other ongoing employee. You will see next when we talk about the new variable hour and seasonal employee, which is your other option for new employees, is that gets a little bit tough. New variable hour and seasonal employees makes things a little bit more complicated, a lot more paperwork, a lot more keeping track of what's going on. And so I think having a new full-time employee is significantly easier to administer than having a new variable hour employee. Obviously, there are situations where you just really don't know, and you're going to have variable hour employees, and that happens, and it's fine. It's doable. You can do it. But if you are thinking about, oh, I wonder if this person should be full-time or not, how are we going to advertise for this position, what are we going to tell this employee? If they're on sort of that line, consider the administrative savings you will have if you just treat them as a new full-time employee, offer them coverage within 3 months, and then dump them in the ongoing employee bucket. Just something to keep in mind. So let's go ahead and talk about everyone else, the new variable hour and seasonal employees. Your new variable hour and seasonal employees have their own set of measurement period, stability period, and administrative period. Their measurement period is called the initial measurement period. It's also between 3 and 12 consecutive months. Their stability period is the same length as the stability period for ongoing employees. Take note, same length. It's not going to be the same time frame. Also, you can have an administrative period of up to 90 days. Couple things to keep in mind when talking about new variable hour and seasonal employees. You can measure these new employees for up to 12 calendar months without incurring any penalty. So if you have a measurement period that's 12 months long, you're not going to be penalized for any of your new variable hour seasonal employees in that initial measurement period for those 12 months. I would recommend taking advantage of utilizing that full 12 months as opposed to doing something shorter like 3 or 6 or 9. Again, still recommend the 12 months long. Also, your measurement period is probably going to be very similar to what it is for your ongoing employees because they have to have the same length stability period. And so if your ongoing employees have a 12-month stability period, your new variable hour and seasonal employees have to have a 12-month stability period. Therefore, your new variable hour and seasonal employees should have a 12-month measurement period as well. Also, your measurement period, the initial measurement period for these new variable hour and seasonal employees needs to begin either on their start date or in between the employee's start date and the first day on or in between the employee's start date or the first day of the first calendar month after the start date. And just keep that in mind. That'll make a little bit more sense in a couple slides here. A few additional rules. The initial measurement period plus the administrative period cannot be more than 13 months and a fraction of a month. That fraction of a month is that time frame. Maybe your employee starts, June 10th, but their initial measurement period doesn't begin until July 1. And so that's where that fraction of a month comes in. And so your initial measurement period plus the administrative period cannot be longer than 13 months. So if you have a 12-month initial measurement period, you're going to be limited to a 1-month administrative period. Also, keep in mind, during all of this, you also have to start measuring this new variable hour and seasonal employee using the standard measurement period for your ongoing employees before the end of the new employee's initial measurement period. So what does that actually look like? It sort of looks like this. So in this example, we have an employee starting approximately May 20th. We'll say May 20th, new employee starts. You're like, great, new employee, I want them to have an initial measurement period beginning June 1. And so you say, yep, that's totally fine because I can have an initial measurement period beginning on or between the employee start date or the first day of the next calendar month. And so June 1 works great. You're going to have a 12-month-long initial measurement period. And so that initial measurement period where there's no penalty assessed, you're going to take a look at the hours this employee is working from June through the next May. Wonderful, great. So now you have a administrative period, a 1-month administrative period, and then you're going to start the stability period on July 1. So that 13 months and a fraction of a month is the 12 months initial measurement period, the 1-month administrative period, and then that fraction of May between the employee start date and the beginning of the initial measurement period. So you've satisfied that rule. Your initial measurement period and your stability period match up correctly. Your stability period is the same length as the stability period for your ongoing employees. Everything's great. So July 1 is when the stability period starts. It's that bright blue. You offer coverage if the new employee is full-time during their initial measurement period. At the same time you're doing all of this, you also have to measure the employee's hours using the standard measurement period and all of the stability and administrative periods you use for ongoing employees. And so you can see, continuing on with the same standard measurement period that we've been using, the standard measurement period begins in December. That's the M1. You're going to measure the employee's hours for the standard measurement period December through the next November. That's the M1. Now the employee's already been offered coverage, and so they're hanging out in their stability period. And you are measuring them with the standard measurement period, and they've got an administrative period there in December. And then a stability period begins January 1. This is sort of like the standard stability period that applies to ongoing employees. And a couple things could happen at this point. First example, if the employee is part-time during their initial measurement period, so they're part-time for that bright red initial measurement period, therefore they have not been offered coverage yet because they were part-time during their initial measurement period, but ended up working full-time hours during the standard measurement period. That's the M1, sort of the darker red. You then have to offer them coverage during the standard measurement period, our standard January through December measurement period, the sort of greenish blue S1. So you did not offer this employee coverage in July because they were part-time, but you ended up offering them coverage as of January 1 because they were full-time during the standard measurement period and part-time during the initial measurement period. Another example, your new employee is full-time during the initial measurement period. They work full-time hours during that bright red IM1 initial measurement period, and you say, great, wonderful, I'm offering you coverage as of July 1 during that first stability period, that bright blue. Then you find out that during the standard measurement period, the M1, the sort of darker red, they didn't average full-time hours. So you're like, great, they were full-time during the initial measurement period, but now they're not. Now they didn't average full-time during the standard measurement period. Well, because the stability period is what it is, and because the employee's classification of full-time or part-time is locked in during the entire stability period, you have to continue offering them coverage through the end of that stability period, that initial stability period, the bright blue S1. And then after that stability period is over, you can drop coverage because they're no longer full-time. So basically, they would have the coverage through June, through the end of June, and then you can drop because the employee is now a part-time employee. And you can see how it gets quite complicated with these new variable hour and seasonal employees because you have multiple measurement period, multiple administrative period, multiple stability periods going on. And this is only one new employee. If you hire new employees every single month of the year, you could have a lot of different initial measurement periods floating around, which is why I recommend that you hire new employees with similar start dates and you group them together into the same initial measurement period, which basically means if you hire a bunch of employees in May, you want to group them all together to have the same June 1st initial measurement period start date. Same thing, you hire a ton of employees in June. Fine, great, wonderful. Group them all together for a July 1 initial measurement period start date. And so the maximum amount of initial measurement periods you'll be dealing with are 12. And if you can cut it down even more than that, hire twice a year, hire 4 times a year, you can start cutting down the administrative tracking involved with the initial measurement period and transitioning into an ongoing employee. It just gets significantly easier when you limit the number of initial measurement periods. So that was a ton of information in a fairly short amount of time about how to actually apply and set up your look-back measurement method for our 3 types of employees, the new, full-time, new variable hour and seasonal, and the ongoing employees. But there are a couple other things to keep in mind when talking about the look-back measurement method. So I'm going to take about the last 10 minutes here to talk about some of the other rules that pop up that people don't necessarily think about as much. The first one I want to touch on is documentation. Obviously, this is a whole brand new rule, brand new requirement for employers. What do you do about documenting? Do you have to document it? Where do you document it? How long do you keep the documents? There are no specific rules in the employer mandate about methods for documentation, how you document, where you keep it, do you document, what do you document. The IRS, the new reporting rules, which we'll talk about during the next webinar, require you to indicate if you use the look-back measurement method, but you don't need to give specific information. For example, you don't need to tell the IRS, my standard measurement period are these 12 months. My administrative period are these 2 months. This is when my stability period starts. Here's my initial measurement period, et cetera, et cetera. And so you just have to tell the IRS that, yep, I use the look-back measurement method, but that's it. That being said, good documentation can be very, very helpful, especially when this is so new, both to you as employers, but also to the employees that it impacts. And so if you document employee classification, you document the proof of the offer of coverage, you document the timing of their offer, the standard measurement period, their administrative period, their stability period, the hours that they worked, how you calculated the averages, which you're going to have to write down someplace somewhere. Nobody can keep this all in their head. And so you're going to be writing it down anyways. You might as well just keep it. Just save it somewhere. Because this information will be very helpful if you ever have to refute an allegation that an employee who's a full-time employee was not offered coverage. You don't want these employees to go to the exchange and misinform the exchange about whether or not they were offered coverage, get a premium tax credit, and trigger a penalty for you. You want to be able to have the documentation to say, this employee was mistaken, they are not full-time, and this is why. These are the hours they worked. This is how we averaged it out. This is their look back. This is their measurement period. This is their stability period. They're not full-time. Or, yeah, no, they totally were full-time, and we offered them coverage. We offered them coverage on this date. Do you see this documentation about offering them coverage on this date? So that's going to be really helpful in the event that you have to go down that road and refute any of these allegations that someone was not offered coverage or thought they were full-time but they're actually part-time, things like that. So while there are no specific rules and you will not necessarily get in trouble for not documenting this information, I would strongly, strongly recommend keeping good notes, keeping good documents about how you apply the look-back measurement method. Also, one other thing to note about documenting things, you should really make sure that your plan documents, SPDs, everything you have for your benefit plans reflect any type of eligibility changes that come with the look-back measurement method. For example, wording changes like someone works 30 hours a week versus someone averages 30 hours a week can end up making an impact in certain circumstances. So let's talk about some of the other additional rules. We're not going to go, we don't have a ton of time left, and this has already been a very information-packed webinar, but there are some additional rules that I want you to be aware of so you know to ask about them if they impact your business. The first one is what to do with special unpaid leave. So special unpaid leave is another one of those new defined terms specifically for the look-back measurement method, and this is FMLA, USERRA, or jury duty leave. And so if you have employees that are going out on one of these leaves, FMLA is going to be the one that comes up the most. How do you determine hours of service for full-time versus part-time calculations if your employee is out on FMLA leave? Because they're not working. They're on FMLA leave. But at the same time, the IRS, DOL, and Department of Health and Human Services recognizes that anyone who takes FMLA leave shouldn't be penalized and shouldn't have their insurance coverage revoked because they're not working the required hours. And so this is how you treat special unpaid leave. You basically either exclude FMLA leave from the calculation, so say they're on leave for 2 months, just take those 2 months out of the equation for averaging their hours, or say, hey, the employee averaged 35 hours a week for every single other week they worked. We'll just impute those hours during their FMLA leave. So they're out for 2 months on FMLA leave. They always work 35 hours a week. Great, we'll just say they work 35 hours a week during their 2 months of FMLA leave. And so the goal is to prevent this special leave from reducing the employee's hours of service, which could impact whether or not they're eligible for coverage. So keep that in mind. Again, this just applies to FMLA, USERRA, and jury duty leave. Another very, very special rule that comes into play, actually more than I anticipated, is the break in service rule. And so this is a rule that tells you what to do when you have employees that are, leave employment and come back, or have a break in service, or, you hire them for 6 months every single year, but only for 6 months. But then they come back every year. And so you don't know whether to treat them as a new employee or whether you have to take into consideration their previous hours of service. And so this rule basically says if they have been out of your employment, if they've had a break, they have not had any hours of service with you for more than 13 weeks, you can treat them as a new employee. So that means you decide if they go into the new full-time employee bucket or the new variable hour and seasonal employee bucket, and then you just treat them like any other new employee. If this employee has a break of service of less than 13 weeks, the employee might have to be treated as an ongoing employee, which means you have to take into consideration their previous hours of service. And so you can see that rule, break of less than 13 weeks, but more than 4 weeks, and the break is longer than the period of employment, they are treated as a new employee. So employee has a break of 4 weeks. We'll say 5 weeks. So the break is less than 13 weeks, but more than 4 weeks. Their break is 5 weeks and is longer than the period of employment. So this employee worked for you for 3 weeks, then took a break, quit, or something happened, and had a break in service for 5 weeks. That wasn't special unpaid leave. They quit. They worked 2 weeks. They said, nope, not for me. They quit. 5 weeks later, they're like, actually, I want to come back. And so you rehire them. Because this employee had the break of less than 13 weeks, but more than 4 weeks, and the break was longer than the period of employment, you can treat them again as a new employee. You determine if they're new full-time or new variable hours / seasonal, put them in their respective buckets, and measure them like you would other new employees. If the break in service falls into anything not covered on this slide, you got to treat the employee as an ongoing employee. So you just take into consideration their previous hours of service. You put them right back into the measurement period or stability period that they were in before their break in service, and you continue treating them like an ongoing employee. Another special rule to look at is using payroll periods for your administrative and stability and measurement periods to make it a little bit easier. Generally, the rules say that measurement and administrative stability period have to be calendar months. Generally got to be calendar months. However, the IRS, DOL, Department of Health and Human Services, recognizes that many employers have payroll periods that do not match up with calendar months. And so how do you if you're going to use your payroll periods for determining how many hours someone worked, how do you match that up when the payroll period is not the same length, or it doesn't end when your measurement period starts or ends? And basically, you can use payroll periods. And so, for example, if you have a payroll period that goes through January 1, and so you want to start your stability period after the payroll period ends, or start the measurement period after the payroll period ends, like January 3rd or 4th or something like that, you can do that. And then just note that in order to get a true 12 months of that period, that measurement period or whatever it is, come the end of the measurement period, you're going to want to make sure to include the next payroll period so you have a true 12 months. But just know that that's something that you can do if your payroll periods will make it a little bit more complicated to determine hours of service that someone worked. And then just very quickly here, I know we are running out of time, but note that there are some interesting interactions with 125 cafeteria plans because generally employees cannot go in and out of a tax advantage plan mid-plan year. You have to commit to an entire year of a certain tax advantage status. And so there are some different ways, different amendments you can make to your cafeteria plans to make this a little bit easier for employees to, say, revoke a cafeteria plan election when they anticipate a reduction in hours or going less, averaging less than 30 hours of service a week to match up with dropping major medical coverage and things like that. So just keep in mind, the slide's fairly self-explanatory, so you can read it on your own time. If you have any questions, like I mentioned, please feel free to send me an email, give me a call. My information's there. Also, you can always come. Oh, there we go. And with that, I just want to thank you all for joining the presentation today. I will make sure that Kelly has a copy of the PowerPoint slides if that is something that you would like to have. Feel free to give her an email. She will have all of them. Again, thank you very much, and I would highly encourage you all to attend the next webinar on June 24th about the new IRS reporting requirements, and have a wonderful afternoon. Thank you.